Well, hello folks, I'm Ellie Little and this is your weekly TA wrap, where we take a look at these markets and we do it from a neoclassical perspective, each time asking ourselves what happened last week and what might it tell us about the coming ones. I do the show every Sunday night live at 9 o'clock Eastern Time here from the base of the beautiful Rocky Mountains. Folks, we had a long weekend, 3 days off. Friday was closed. Thursday, not much happened as a result of it. If we pull over the daily chart here on the S&P 500, just grinding higher a little bit here. When you look at this from a daily perspective, remember we had a retest regen. That retest regen did not regen. In other words, it failed to regenerate lower. And when you see something like that, right, that tells you that whatever was attempting to get underway, in this case, it was an attempt to push, farther down. It was starting to, grind down, and then we got the bump up, and then the question was, would it go down again? When it doesn't regenerate, even after coming off these highs, and in this particular case, broke 3 swing points, went to a sideways trend, then onto a bearish trend, all in one fatal bar, that tells you that trend that was going on there is no longer, and that you're back in a range trade. So there's been multiple ranges inside here, right? There's kind of 3 ranges going on. There's the one at the top, the one at the bottom, the one in the middle. We're in the middle. Now we're trying to get back up to that top of that breakdown bar. And that's really what's going on a daily basis. If you swing it back out and you look at it on a weekly basis, all it is consolidation or distribution up here at these highs. Now, we really won't know that until we really get a break, right? So in other words, and when I say consolidation, distribution, what I'm talking about is, are the larger players distributing their stock? Are they lightening up on their positions, getting rid of them? Or are they simply accumulating? So in other words, each time you come down towards the lows of whatever the range is, those buyers are able to put more on, right? Build up their positions, make the size larger. That's the accumulation phase. Distribution is the opposite. You're taking what you have and you're getting rid of it. You're pushing it out. The question always, when you get some sort of a sideways action going, is which of these is it? Do you have accumulation or do you have distribution? And those are very different things, and the problem is it's hard to decide which one it is. And it takes a while, right? Because distribution phases, accumulation phases, they can last for long periods of time. In this particular case, we've got about a good 12 weeks now of essentially distribution or accumulation taking place. So when you look at it from that perspective, right, there's not much here to tell us which one it is. We've come down with more volume each time we've come down, but then again, we're not really giving anything up. The S&Ps basically, they're up for the year. If I go back to the end of December, they're slightly up. If I look at the NASDAQ, INDX, the others, they're slightly down. Just a lot of sideways. And after a year of a huge amount of gains, that is not a bad thing. If it turns out to be distribution, well, then of course it will be a bad thing. But at this particular point in time, it's not easy to make that call, and it certainly isn't easy to know which of it is. Now, what you do have to watch for is breaks, right? And in this particular case, if we're looking at the S&P 500 on a weekly basis, if we were to trade back down into this area, and specifically if we were to break to the downside, then that might answer the question. And so one has to be looking at that from a weekly, because this is where you can really get hurt. In other words, a break on this time frame of that magnitude would probably take you down quite deep. And when I'm looking at this 1635 from almost 1900, 270 points, yeah, that's a pretty good correction. And instead of a pullback, then you're starting to talk correction. Right now you can't talk correction because it hasn't happened here. But if we go over and we look at some of the other indexes, in particular the ones that have been weaker, here we can almost talk about corrections. And what I mean by almost is we're down deep enough now, and I'm on the weekly on the NASDAQ composite, the broad composite. We're down deep enough to where there are tests taking place on the intermediate term time frame with respect to the trend. And that trend has been up for a very long time. Now that it's threatening to break those down on this time frame, and if you get an intermediate term time frame break, especially if it carries some, you're talking about corrections that are on the order of greater than 10%, right? And a greater than 10% correction, a greater than a 10% pullback, I would call a pretty good correction. They call bear markets anything greater than 20%. And if you break the intermediate term time frames, 20% is definitely possible. And that's why these are so important. That's why everybody takes a look at them, or at least they should take a look at them, and they should stay in tune with what they're doing, because if they start correcting these amounts, right, 10, 20%, now you're talking about something serious. In other words, if you're fully invested and you take that kind of a hit, you're going to know it, right? These are the sorts of things you have to protect against. We've already had almost 8%, 8.5% off the top. That brought us down to test it. Now we're getting the bounce. The question is, will the bounce carry? As far as the listed issues, it looks like it will. It certainly has. But then if we go over and we start looking at the NASDAQ and we look at the Russell, right, that's where the more serious damage has been done. That's where the breakdowns are possible. At the same time, this may simply be, an opportunity for some to get longer. And if I were doing the old stuff I used to do and looking at, inverse head and shoulders, I could certainly make out an inverse head and shoulders here. The problem is, according to Edwards and McGee, the volumes don't line up. These volumes should be smaller than this one, and they're not. Now, maybe it won't matter. Maybe it will, but, it's not ideal, I guess, is what I would say. And because I don't pay that much attention to those anymore, I'm more interested in how are you coming back and testing. So when we're looking at the Russell on a weekly, the big bar it came into, which was a hammer bar low back on Feb 3, that reversal, it was a 2.03. We came into it with 1.8. We go under it, back over it with less volume, do a hammer, right? That says this thing wants to try to trade higher, which is what it's doing. That's on the weekly. If you look at it on the daily, the real test is going to be that retest regen. And because the Russell has been probably the best index to give clues, this is going to be a key level. If you start looking back here and you're seeing declining highs, swing point highs, right, declining, if it doesn't get over this one within a bar, let's see, 1, 2, let me see if we have enough here though. 1, 2, 3, 4, 5. Actually, it's not going to be able to print a swing point high there. So it's not going to matter, but that is the breakdown bar, and this is the retest regenerate zone. Anything over this definitely says that downtrend has been in place, probably has changed on a short-term time frame. And as a matter of fact, if you get over the retest regen zone, which is here, that tells you more than likely you're back into some sort of a sideways range. So Retest regenerates. They're key to giving you a heads up at an early point on breakdowns up, or breakouts up or down, leading back to sideways trends or leading to further declines. And so that to me is probably the most important thing to get out of the general markets at this point in time. If you look over to sectors, over here, and I'm going to pop into the strongest ones first, you have some good action taking place in the transports. You can see it here on the weeklies. Transport's going to go back up and test the highs. You actually have breakouts in the energy sector. That breakout began here, what, 3 bars ago? Usually that says 2 to 3 bars extension. It did do a retest regen already, which is kind of converse to the 2 to 3 bars extension, but it did regenerate higher and volume came into it. So nice big spike on the energy. The other ones that have looked strong and continue to look strong, XLP, that one's going back up, breaking to new highs. The XLU, which is the utility sector, has been pushing new highs. And those 4 are the strongest. If we go to others that are still maintaining, you got the SOX that's in some sort of a bounce mode here, but the jury's still out on the SOX. Looks like it does want to trade lower when you look at it on a daily. If you look at the material sector, that one's just range trading at the highs, which still looks okay. It's at the top of the breakdown bar on the dailies. XLF hasn't gotten back up there. This has been one of the weaker ones, but it did do an inside bar, some good volume coming into it. That one's probably going to try to test that breakdown area. Another one that's actually been strong, I missed on the way in on the intro there, has been the XLI. Nice volume coming back up on a weekly. There's really 5 of the 9 that look pretty strong. XLI would be in that group. XLK, this one actually has been doing pretty well, even with the big cap tech sector being weak. So this one is coming back up. Looks more like the XLF than it does, say, the XL or maybe the IYT as an example. A little bit weaker, but still not too bad. And then we go to the 2 sectors that really probably took the brunt of the selling. The XLV, mainly because of biotech. That one's getting a bounce, but it actually has higher volume on the lows from last week. So I suspect it will be down again at some point. And the discretionary, consumer discretionary, also looks weaker. So when you look at the sectors on a weekly, they still don't look that bad. So across the board, indexes, decent bounce going on. Retest regen on the S&P 500 failed, so it's back into a range trade. Retest regenerate on the Russell coming up. That will be a big test. Probably happens this week, could happen Monday or Tuesday. And across the sectors themselves still look pretty good. You know, it's on the weeklies they look fine. On the dailies, some of them are still struggling. Many of them are going to come back and do those retest regens, and I'll just pull this XLY week daily over. That retest regen coming back into the swing point low. Actually, the one that broke, in this case, it's not going to have one because that one broke and was already retested. The test on many of these is that breakdown bar. That will be the big test on the way back up. So that breakdown bar is April 10th on almost all of them. So you can simply look at that bar and measure what kind of bounce it does or doesn't get. If we look overseas and we look at those markets, you know, Europe is pretty stuck. And I'm going to pull the weeklies up on the European, the major 3. Here's your CAC, which has been the strongest one. There's really no significant volume on the way up. The volume was on the downside. That one looks to me like it's just going to range trade and try to grind lower here at some point. The German DAX is the second one. The FTSE's the weakest. So here's the FTSE, just a big range trade going on, nothing there. And if we go over to the DAX had been the strongest one, but hasn't been that for a while. The CACs had taken over that leadership role. You can see here a large sideways in the middle of the range right now. So I don't really see anything in Europe. Maybe that's because of the situation in Ukraine that's really holding it back. Maybe it's something else, but Europe to me appears that it's kind of stuck in a sideways trend at best. If I look over at Asia, the weakest, even though it's been strong lately, the weakest two indexes or three indexes really is Hong Kong. Here's the Hang Seng, this is the weekly. It's still doing a big range, primarily this area. It's still in it, working its way towards the top. Had some nice volume expansion, so I expect it's going to try to make another run for these highs here and see if it can get over them and get up into that last part of that range. But still a range trade there. And if we look at the best view that we have of the Chinese Shanghai market, you can see it had a nice pop up as well. A little bit of a drawback. That one also left some decent volume and probably is going to try to trade back up there. But if you break it down and look at it, you know, you've got a huge range here as well, and it's really battling to get back into the top half of it versus the bottom half. And so, you know, on a larger scale, on the weekly, the intermediate term time frame, that one still is kind of stuck in a rut. The other big market economy is Japan. And when we look at Japan, Japan has a large range total, right? A large range in place. It's right at the middle of that range almost, trying to break down. It didn't have enough gusto to break it down. It's getting a bounce off of it, but I don't think that bounce is going to carry. It looks to me like, from a daily perspective, it's going to try to roll back over. The Nikkei appears to have the same sort of situation that we've seen elsewhere, where easy money comes in, floods it, you get the huge run up, and then you gyrate for a while, you finally test it, you can't break it out, now you're getting consolidation. Potentially it's accumulation, but then again, this could be distribution. It's that first question that we started with. The point being, in Asia, the two largest markets look like they're fairly stagnated. The rest of them look pretty good. As a matter of fact, they all look pretty good outside of that. So, world markets, most of the big markets, they're range trading. The smaller markets, still bullish. Domestic markets here, mostly range trading, a little bit slightly bearish on the OTCs, bullish on the listed indexes. And so, you know, what we're really talking about is divergence between the two. So if we walk over to the OX markets and we say, okay, so what's happening over here? Is there anything over here that gives us a better clue as to what might be coming? We can start with the dollar. The dollar is trying to break out the lows, has been trying to break out the lows, hasn't had the volume yet. And so the dollar still is range trading itself. And as long as it range trades, right, that's not going to put juice into these markets more than likely. It's at the bottom end of the range. You know, if the dollar were to sell off, that should correlate, as long as it doesn't do it in a fast, furious manner, that should correlate to higher equity prices, because those equities become quote-unquote cheaper with a cheaper dollar. But you can see the ranges that are in place here. It's in the bottom one. Been trying to break it down and make a new one below it, but hasn't been able to. We'll see if this dollar flips around over time, because if it does, I think that's going to make it hard on equities if the dollar gets too strong too fast. If it just meanders, it probably doesn't matter. But then we look at the bonds. And the bonds continue to try to work higher, They actually worked higher last week, had heavier volume, did close lower, but the volume was heavier, which suggests to me it is going to try again. It's going to try to push higher again. It still looks to me like the TLT, and we're looking at the long end of the treasury curve, it still looks like it's going to try to make it up to this area. And to get up there is going to require equity prices, more than likely, to become more pressured, I would say, because I can't think of any other reason the TLT would want to go up. If that's true, then equities still have more work to do, and there's still the possibility, shall we say, of more downside pressure on equities at some point. If I look at the continuous commodity index, big spike up, it's just hanging up there. This one also looks like it wants to try to go higher. You know, if I look at what the government tells me, there is no inflation, but when I look at that one says it looks like there is inflation coming along. So if I pop over and I look at gold and say, okay, is gold getting something out of that? So far, the answer is no. Gold's stuck in a range. As a matter of fact, if you pull the daily over and look at it, gold looks like it's going to try to break lower one more time. So it made a big climb back up, finally got a huge day down, volume expands. It did test under it. That says it's probably going to try to test the other side. That's 125.70. If it can't get back up there, though, you know, and start closing this gap, then you got to expect it to come down again. And I suspect that is what it's going to do before it's done. These markets, when they try to turn, and I do think gold is trying to turn, they take a long time. And as you can see this, you know, this has had a nice big spike up, but I wouldn't be surprised to see it come down here and test it all again before it's over, because there's not a lot of interest from a volume perspective in the gold market. And when I look at silver, silver echoes that even more so. So it doesn't look to me like the fear trade or the inflation trade is helping gold. It really is helping bonds. The money's running to bonds when the fear trade is on, and nobody believes there's inflation. And maybe for good reason, because you still have lots and lots of debt all around the world, and that debt continues to put pressure on price, you know, in terms of all price increase. You know, if you have too much debt, you're not going to get much in the way of price increases, and there's way too much debt right now. Okay, I saw a message here when I first popped in about DGI. DGI was a company that we had traded, we being the subscribers and myself, for some period of time. A good-looking stock at the time. We bought this way back, I don't know, it was 24 bucks or something when we first got into it. And I'd have to go back to a monthly probably to even find out where that was. You could look at my records if you want, but you know, somewhere back in here, it started to perk up, and it looked like a good trade. We rode it up, made several buys and sells on the way up. We got caught with some at the end, had to sell it off, and didn't make anything on that. But overall, we're able to do pretty well with it, and then, you know, exited when it took this big hit. This big hit was on earnings day, 3 months ago, first quarter. It really wasn't so much off the earnings, but off of a takeover of another company that would give them the ability to sell their images better. Probably the biggest weakness of DGI was they did not have in place a great resale of their digital images. Most of those images, or a great number of those images, were being sold to the government, and they weren't able to sell images to a widespread audience outside of the government, and that was why they were doing this takeover. But it was undisclosed terms. They got sold off on it, and you can see what's happened since then. Now you get a spike up, and the news, as Tommy tells us here, is the intelligence community has thrown its support behind a bid by DJI to sell higher resolution images. DJI for some time now has been restricted, and when I say some time, I'm talking about years, from selling higher resolution images to commercial sources. That restricts them to some degree on what they can and can't sell. And what I mean is that market, the size of the market that they can sell to is necessarily diminished as a result of not being able to sell the higher resolution images. I'm not sure what the motivation for the intelligence community getting behind them. For that reason, I have no idea. I do know that Digital Globe, contrary probably to what is publicly said, they sell high resolution images. They can get much, their technology in the sky already allows much higher resolution images than they sell. All they have to do is quit diffusing those images, if you will, if this were to pass. And that's what this bump is. Now, that's the fundamental behind it. The question is, does that make it a buy or something? Well, no, not really. When I look at this chart and I look at the damage that was done here, can you get a pushback up? Well, the first stage of getting a pushback up is to change your trend. Right now it's bearish on the intermediate term time frame. I believe, let's check it. I know it is on the daily we just saw, and yes, it is on the weekly too. And if we go to the monthly, I don't know if it's turned yet. Let's see. No, it hasn't. So the monthly is still bullish. So then the question is okay, what would it take, when you get this kind of a sell-off, what does it take to get you interested again? Well, you can always go back to the daily, and the first thing you want to see trend change on the daily. Because when you get this kind of damage, it's going to take a while before it recovers, so you don't have to try to rush into it. So as it comes back up, what you're watching for is you're watching for trend change. And how does that change? Well, it changes on swing point highs being broken. So if you were to see a couple swing point highs broken, especially if you were to see multiple swing point highs broken on one swoop, then you can start to get interested, because then something's happening. But right now you haven't. The other thing that you want to see is you want to see the volume come back into this thing. And so far, that hasn't happened. And so until you see those two items begin to show signs of life, I don't know that there's a lot of reason to even consider this other than potential bounce trades. Certainly not for the longer term time frame. So that's kind of my spill on Digital Globe and anything that has a formation like this where you get significant damage. It takes a long time to repair that damage. Digital Globe is still a monopoly. It still will make a lot of money at some point. It's all about timing, though, right? You gotta get it at the right time. Yeah, maybe this is the low, but I feel fairly certain that there will be plenty of trades down in this area, that one can make over the next few weeks and months, and we just have to watch it develop. And when those things I talked about develop, then you got something. All right, I've run out of time here. This week, next week, you got divergence in the markets. You've got divergence in world markets, in that the big ones are sideways trading, the smaller ones are strong. Domestically, you got strong listed issues, you got weak technology, you got weak OTC. There's things to watch when those tests take place, the Russell, those breakdown bars. Then we'll learn more and we'll see where this market wants to go. For me, for now, looks like a sideways market to me. Have a great night. Take care of yourself. I'll see you next time. Good night, folks.